Hi, I'm Mike Ward. I want to talk to you about something that's quite a common feature in finance and economics, and it's called the CAPM. That's how you're going to hear it. But it stands for the Capital Asset Pricing Model, which is a rather long, involved kind of way of talking about how do we calculate the return that shareholders should get for taking on some risky equity investment. So if you've got a company and you want to know what's a fair return for shareholders, you're going to see that we plug it into this model called the Capital Asset Pricing Model. So let's go and have a look and see what that's all about. Now, I'm using actual data here, and this is the StockX 50, the 50 largest companies in Europe, if you like. And I'm using 5 years of data to plot this little chart. Now, you will observe here, I've worked out the monthly return over 5 years for these 50 companies. Each one of these dots represents one of those 50 companies. And on the x-axis over here, I am plotting the standard deviation, which is commonly used as a measure of risk. So we've got risk always, by the way, on the x-axis and return on the y-axis over here. And you can see a few interesting things. So it's possible, for example, you'll notice to have negative returns, but you can never have negative standard deviation because when we calculate standard deviation, we're always squaring things. So it's possible that some companies actually over 5 years gave you a negative return. Here's a really bad one, a negative return, and it also had quite a high standard deviation, which is a measure of risk. But if we were to, if you look at this plot here of each one representing 5-year average return and standard deviation for different companies here, you'll observe that if you took an equal weighted portfolio of all 50 shares over that 5-year period, you would get this particular point here. This is the portfolio's risk and return. Now, what's interesting about this is that we are actually getting the average in terms of return here. And you'll see there's actually an equal number of shares, maybe not equal number, but certainly in terms of the distance away from this red point here, above as there are below here. So this red point represents the average monthly return that those shares would have given you. But if you look carefully, you're going to see it's not the average standard deviation. Just eyeballing this here, you can see that would probably be somewhere around here. This point here has probably got the average risk of all of these companies here. So this is what we refer to as the only free lunch in investments. The fact that when you just randomly put shares together, you get a reduction of risk. And there's a reason for that. And it's fairly well understood, in fact. Now, we know that, for example, if we were to pick these two shares over here, that if you put all your money into this one share over here, you would have had that much return and this much risk down here. We could see this, and similarly less return and less risk for this company over here. But the interesting thing is, if you were to take a portfolio of these two shares, so let's say, for example, you put 60% of your money into this company here and 40% into this company here, you would actually find that you get a portfolio, 60-40 portfolio, somewhere over here. And the reason for that is because these two shares are unlikely to be perfectly correlated. So the minute you find that there's imperfect correlation between two shares, in other words, if this share went up exactly the same time and the same amount as this share over here, we'd have perfect correlation and there would be no benefit. This little curve would actually be a flat line straight between here. But because they're uncorrelated to some extent, we get some benefits here. We are able to reduce risk. If, and this never happens, we had two perfectly uncorrelated shares, in other words, the correlation coefficient was -1, then what that would mean is if this share happened to go up by a certain amount, this share would go down by the same amount. They'd exactly offset each other. This dotted red line I've sketched over here would actually go all the way across to this y-axis here, right to zero. In other words, you could completely get rid of the risk. But there's never going to be two shares which are perfectly uncorrelated. So that's of no real help to us. But between these shares that we've got over here, there's going to be different levels of risk and return and correlation. So you might find between these two shares that I've put over here that there's not much benefit from picking a portfolio of these two shares because they're actually quite highly correlated. Therefore, you're not getting much bend in this line over here. But on these two, if you put these two into your portfolio, you put 50% into each, you would probably, you'd get the average return. Notice the average return between these two shares over here, but we're not getting the average risk. The average risk would be somewhere here. We're actually getting a huge reduction in risk. Now, what we're talking about here, these correlations and so on, has been known for a long time in financial markets. And the story goes that a young PhD student at Chicago University by the name of Harry Markowitz was sitting in the waiting room for his professor to discuss his PhD. And in the same room was the professor's stockbroker. And whilst they were waiting, they were chatting. And the stockbroker said to Harry, "What are you going to do your PhD in?" And Harry said, "Well, I don't know, but I'm pretty good at optimization." And the stockbroker said, "If I gave you a bunch of share data with returns and standard deviations and correlations, could you optimize that?" And Harry said, "Yeah, pretty sure I could. I'm good at that." And that's what he did his PhD on. So what actually happened was Harry took a bunch of data from the US stock markets, actual share returns, but like what we are talking about. And he, instead of just putting equal weights, because our little red portfolio down here is based on equal weights, we've just put the same amount equally into this portfolio, is he played around with the weightings and he actually was able to come up with an optimized minimum variance portfolio, which I've plotted over here, which is way better than this one over here. And after he'd done that, he actually constructed what he called an efficient frontier. He found the combination of shares that you could get just in the right weightings, which would put you onto this red line over here. And in fact, if you kept going, you could also go down here, although nobody's really interested in the bottom half of this curve here. It's just from this point here that we're interested. He called this thing the efficient frontier, and anywhere from the point of minimum variance here, we've got the least possible variance, to anywhere on this top part of this line here became of great interest to investors. Because what you could do is you could come along, in theory at any rate, and you could assess the riskiness of an investor. So you might go along to a young lady and assess her risk appetite by asking her certain questions. We might say to her, "What car do you drive? How old are you? How many children do you have? How many husbands do you have?" And we might assess that she should have quite a lot of risk, somewhere over here. Then we go along and we say, well, if you want that much risk here, we can go to the highest point that Harry could actually find for us. We phone him up and we say, "Harry, please can you tell us what combination of these shares and what weightings must we put in to give us this particular point?" And Harry would have a look at his maths and whatever and tell us that point is made up of these shares over here and this weight and so on, and that's going to put you right there. And that's what she should handle because she can sit, she can handle that much risk. But then we would go along to another investor, Investor B, and we would say to Harry, "Well, we've now got this guy over here, and he's kind of old and, he can't handle too much risk. And could you tell us what shares go into this portfolio here? Because we want to give him, not this bottom one, because we can, for the same amount of risk on this axis here, we can actually get the top part of this curve here. Please can you tell us what shares should go in there?" And Harry could look it up. He could calculate all of this, assuming he knew what the returns would be. He knew what they were historically and what the correlations would be for the future. He'd be able to pinpoint this point. So this was quite interesting to the investment community. But having done all this, Harry got a phone call from a guy called James Tobin. You might have heard of him if you've heard of something called Tobin's Q, for example, but that's another story. And Tobin phoned him up and said, Harry, great piece of work you did for your PhD, very interesting, but you forgot one point. And Harry said, what do you mean I forgot one point? And Tobin said, well, you forgot that there is actually a risk-free rate as well. And Tobin said, but who cares? Our risk-free rate comes from bonds. Bonds are risk-free. But I'm looking at equities. Equities have risk. And Tobin said, well, that is true. But if you include the risk-free rate as one of the possible options, which it is, it's not equities, but it's still there. People can invest in this. It completely changes your map. And Harry said, well, how come? So Tobin has said to him, well, if you just drop a line from the risk-free rate until it touches the tangent of your curve, if you like, over here, we're going to get this particular point over here, which is actually going to be the market, if you think about it. And so Harry said, but so what? How does this help? And so Tobin said, well, it's actually quite interesting, because let's take your investor who you've got in this portfolio over here, who doesn't want much risk. For the same level of risk, I can move him from here up to there. Harry said, how will you do that? He says, well, what we're going to do is we're going to take his money and we're going to put 60% of it, let's say, because this distance is 6 times versus 4 times, if you like, 60% and 40%. So we're going to take 60% of his money and we're going to put it in the market, because we want to move him up 60% from here, and 40% is going to be over here. And that is going to, so in fact, not all of his money will be sitting in his equity portfolio. Some of it will be sitting in the risk-free rate. And that together, that combination of 60% into this portfolio here, we're not going to use your portfolio at all. This is the key one. It's going to be able to raise him a little bit, but we're not going to put all his money there, just 60%. And then 40% in here. That will give him the same risk, but a higher return. So Harry said, wow, that's interesting. But what are you going to do for this lady over here? And Tobin said, well, that's easy. What we're going to do with her is we're going to put all her money into this portfolio here, market portfolio again. Everybody's going to go into that portfolio. And what's different is we're going to go and borrow more money from the bank at the risk-free rate. So we're assuming that you can borrow at the same rate as you know, you can, as is being lended at. And in fact, we're probably going to borrow about twice as much as she's put in here. And that's going to leverage her up along this line over here. It's going to put her at this particular point up here. And this changed everything, because now no longer did we have to have customized portfolios for each of these investors. Every investor is going to get the same equity portfolio. And the only thing we've got to change to assess their different risks is how much they should put in the risk-free or borrow from the risk-free to move them up and down this particular line over here. So this was a fundamental insight into investment theory, portfolio theory. In fact, Harry Markowitz won a Nobel Prize for this in the 60s. So out of this, though, came the idea that there is a relationship between risk and return. We've always actually known that. But if you measure risk in a particular way, we can actually construct this so that it's going to give us a straight line. And that's very nice for us because it makes life so much easier. So this idea, which was called modern portfolio theory, kind of developed into, well, if we measure risk in the form of something called a beta, and we know what the risk-free rate is, let's just say 10% for argument's sake over here. In other words, investors can get a return without any risk. That's a good starting point. If we measure the risk in terms of something we're going to call beta, and we'll explain how we work this out just now, but it's essentially a relative measure of risk for a company against the market. Well, then what we need to know is we need to know that there is a premium for investing in equities over and above the risk-free rate. Another way of expressing that is to say, what is the average kind of excess return you're going to get from investing in shares versus investing in risk-free things like bonds? And it so happens that this number is pretty much a constant. We could argue a little bit with that, but it's around about 5%. How do we work this out? Well, we just look at history. We see that over many years, in whichever country you are in, shares have, on average, in the long term, given a slightly better performance because they are risky. So we call it a premium over the risk-free rate. And that number works out 5 or 6%. We can argue a little bit about that. But what's really cool about this, if you remember your high school maths, is that if we now know that the tangent, the slope of this line here is actually the tangent of this angle here, isn't it? And because we've carefully decided that the beta must be 1, it's going to be, and we just decided that, and we know that the height of this triangle here is going to be the market premium, which is 5%. The tangent of that angle is going to give us the slope of this line. And you will too remember from school that there is an equation, y equals c plus mx. I've written it slightly differently to the way you learned it, because we should really start by saying that what, and y means what? Y is this axis, isn't it? Which is return. So the return that a shareholder should get for a particular share, that's what y really means, is equal to c, which is the risk-free rate here. It's just that constant, what you can get from investing in bonds, plus mx. What is m and what is x? Well, x happens to be beta, isn't it? This is just how far you are along the x-axis over here. And m is the slope of this line, which we've just decided is 5%. So this gives us a really nice simple equation, which enables us to work out the appropriate return, the fair return that shareholders should get. What we need to know is the risk-free rate and the slope of the line and the beta. And so I've written it out like that over here. The expected return on share X is going to be the risk-free rate, what you can get by putting your money into government bonds, plus the market premium here times the beta. How far are we away from, maybe we're down here, our share is less risky or our share is more risky. And so this is where we get the risk-free rate on. This is the market risk premium here over 5. So I'm just assuming 5%. And the beta that we got, let's say, is going to be 1.8. We're looking at a particular share, which is quite risky. If we know this, then we can plug that all together and we can come along here to this, just using this equation and solve it, just plugging in these numbers here. And it's going to tell us that the expected return given a beta of 1.8 and these other assumptions we're making here is going to be 19% for that company. That would be a fair return for that particular share. That's really cool. A very simple model, which we call the capital asset pricing model. And all we've really got to be able to do is work out the beta. So this is what it is. We've actually got this little equation here, and we've got 3 parameters that we need to know. What is the risk-free rate? What is the market risk premium? And what is the beta for the share that we're interested in? These 2 things are pretty straightforward. We can easily go and see what are 10-year government bonds trading at. That's what we usually use for the risk-free rate. Shareholders should at least get that. But also we can look over time and see what on average has the market done over and above bonds. And then based on the beta of the asset, we just plug it in, we get this equation, gives us this expected return that shareholders should get. Now, to calculate the beta, we actually need a bunch of data. So we need for both the share that we're interested in and the market that we're in. Usually we use the all share index for this. We're going to go and obtain some data, and people vary these things, but normally we're going to take 60 monthly data points. So in other words, 5 years of prices, which we're going to convert into returns for each month. And then we're going to plot the index on the x-axis, and this is really important that we get these the right way around, and the share returns on the y-axis, and we're going to do a linear regression on this, fit a line to it, and the beta is going to be the slope of the line. And we will also get an R-squared, which might scare you a little bit because it might be very low. But we don't really care about that, actually, because it just is really a measure of the systematic risk that that particular share has got. And we're going to put our shares into a portfolio anyway, so we're not too fussed about that. So here's just a graphical description of this. This is me doing it for BP. And I'm plotting over here, notice, always on the x-axis, the index returns. And for this particular one, I used the London Stock Exchange here to see how well it had done. 60 different points here of monthly returns, and I did the same for BP. And I then just fitted a line through this using Excel. And you can see here's the equation. I'm showing you what it is. And you can see what it's telling me is that BP is, I should get it in, slightly more. If the market goes up 10%, then BP is going to go up slightly more than that. That's what this coefficient is really telling me over here. If I'd got a coefficient of 2 here, then we'd see a much straighter line, for example. And it's telling me that when the market goes up, say 10%, BP should go up by, well, if this were 2, it should go up by 20%. Here, it's going to go up by twice that. So people get concerned about these things. You'll notice that the intercept is not exactly 0 here. This is actually interesting. This is what we call the alpha. And it's telling me that even if the market doesn't move, BP is likely to go down. So it's not really a good share in that sense. And so people don't like having negative alphas, but it's quite small. And secondly, they're concerned about the very low R-squared. But this is not really an issue for us. We know statistically we should worry about this. But what it's really telling me here is that BP is not that correlated with the market. All that really means is I better make sure I have a well-diversified portfolio. If we had a high R-squared, it would tell me that it closely, fits the market. But you can see there's some big outliers with BP here because it doesn't fit the market. It's just an indication to me, if I get a low R-squared here, that I need to have a well-diversified portfolio, which is important anyway. So we don't worry about the low R-squareds. So once we've got all of this, we want to try and take it to the next step, which relates to what is the cost of capital for a company as a whole, because companies have got both debt and equity. And so here's our equation for the hurdle rate, the weighted average cost of capital, as we like to call it. We need to take the proportion of debt times the after-tax cost of debt, add that to the proportion of equity times the cost of equity. And this is what the CAPM has enabled us to do. So here I've written this out as a formula over here. We're going to take the percentage of debt times the cost of debt for the company. What's the interest rate the bank are charging the company after the tax rate, because we're going to save some tax on this. We're going to be paying interest to the bank, but we actually will be able to claim back some of that interest as a tax deductible expense. That's why we put it here. And then we're going to look at 1 minus the percentage of debt, because we're assuming that the capital is made up of either debt or equity. So if 20% is debt, say, then 100% minus 20%, 80% must be equity times the cost of equity, which is what we're using the CAPM for. So here's a little problem for you to have a go at. Estimate Shell's weighted average cost of capital given the following. We've got a risk-free rate here. We've got the cost of debt for Shell. We've got the risk index. That's the beta. And we've got a market premium of 5%. We've got the market cap of Shell. And we know how much debt they've got, so we can work out the proportion of debt and equity here. And we know what the marginal tax rate is. How hard can it be? Good luck. Have a go.